This is a short video to basically answer one of the many questions that we get either emailed to us or posted on our, the blog or the social media sites, etc. So the question, and this is a common question from a lot of people, is when trading, how can you basically improve your entry point into the markets? Because a lot of people find it frustrating that they enter a trade and almost as soon as they enter, the market goes against them, or maybe hits their stop and then goes in their favour and stuff like that. And it can be very frustrating. So you think to yourself, well, how do you time that so that you cut out that pullback against you and just get in when the market's about to go? And again, there's lots of different entry techniques that you can use. There's lots of different ways that professional traders, including myself, do it. One of my favourite techniques is to use the calendar, okay? And we use something called risk events. And what we do is we do something called trading into risk events, because very often the market will have an expectation for a number, which a risk event, of course, is just an economic indicator that's being released. And the market will have an expectation. So I'll use a hypothetical example that was actually something that happened a couple of weeks back in a trade I took. We had UK GDP. And UK GDP was expected to come out, I think it was 0.7. The previous was 0.4. And the big picture fundamentals on the pound at the time were that the Bank of England were going to hike their rates after the Fed. So that made the pound the second strongest currency. So after the Bank of England said some pretty hawkish things and basically confirmed that they're going to hike their interest rates, etc., the market was buying pounds. Every time it dipped, the market was really in favour of buying pounds. And then the question is, well, when do you buy pounds in line with that? And the answer to the question in this particular example was just in the lead up to this risk event, because GDP is a big figure. It was expected positive and the market's already buying pounds. So it stands a very good reason the market's going to keep buying pounds into the expected positive result. Now, of course, if the result comes out negative, the pound's going to sell off. If it comes out better than expected, the pound's going to go even higher. But the point is the market very often trades into a risk event. So very often you'll see on the calendar the risk event released and the price, it comes out positive and the price kind of goes the other way as everyone takes profits. That's one of the reasons for that, is because the market's already traded into it. Now you can do the same. And if you want to practice this, all you need to do is follow the blog. We post lots of stuff every week about which risk events are the particularly ones you want to pay attention to. We also post the big fundamental picture for each currency. So you basically you get the fundamental picture for the currency, you match it with an upcoming risk event that's coming out in line with that. So if it's a positive picture, you want a risk event that's going to be positive. And if it's negative, you want a risk event that's going to expect it to come out pretty negative. And just make sure you enter within 2 or 3 days. Doesn't really matter when in terms of hours, but within 2 or 3 days, the chances are you're not going to get so much drawdown and you're going to get a nice pinpoint entry. If you use a stop loss of maybe 50, 60 pips, you're going to find to start a much more, you'll have a much more consistent run of how you trade. They're not all going to win, of course, but you'll find those moves against you and that frustrating experience of getting in and the market going against you and stopping you out will happen less and less if you time it better. And one of the simplest ways to do that is to trade into the risk.